Hello everyone, and welcome to Next Vault. Today, we're diving into a fascinating topic: the psychology behind financial markets. Many investors believe that markets are driven solely by economic data and charts. But the reality is far more complex. Emotions and investor psychology play a massive role in market fluctuations. Let's explore how psychology influences financial decisions and how you can use this understanding to your advantage. 1. Fear and greed. The market's driving forces. The two primary emotions that influence markets are fear and greed. These emotions can lead to irrational movements, often disconnected from economic fundamentals. Why is this important? Fear triggers panic selling, while greed drives speculative price increases. These behaviors often result in market bubbles or sharp declines that don't reflect the real value of assets. How to manage fear and greed. Stay calm. Avoid panicking during market downturns. Volatile periods can present buying opportunities if you remain rational. Focus on long-term goals. Sticking to your financial objectives helps you avoid being swept up in short-term emotional swings. Use fundamental analysis. Evaluate assets based on their intrinsic value instead of reacting to collective market sentiment. 2. Groupthink and herd behavior. Financial markets are often influenced by groupthink, where investors follow the actions of others without independently analyzing decisions. This is also known as herd behavior. Why is this important? This behavior can lead to speculative bubbles. For instance, when everyone buys an asset because it's trendy, prices can rise far beyond their economic value. However, when the market reverses, the same investors panic and sell hastily. How to avoid herd behavior. Do your own research. Don't blindly follow the crowd. Take time to understand the assets you're investing in. Be a contrarian investor. When everyone is buying, it may be the right time to sell. When everyone is selling, you might find buying opportunities. Stick to your strategy. Don't let market behavior push you away from your long-term investment plan. 3. Confirmation bias. Convincing yourself you're right. Confirmation bias is the natural tendency to seek information that supports your beliefs and decisions while ignoring contradictory evidence. Why is this important? If you invest in a stock or asset and are convinced it will perform well, you might focus only on positive news while disregarding warning signs. This bias can lead to holding a position for too long, even when market conditions change. How to overcome confirmation bias. Be open to criticism and opposing views. Actively seek information that challenges your opinions. Regularly evaluate your investments. Review positions and adjust them based on new data and market trends. Diversify your portfolio. Don't put all your eggs in one basket. This reduces the impact of poor judgment. 4. Anchoring bias. The impact of first impressions. Anchoring bias refers to the tendency to rely too heavily on initial information, even if it's irrelevant or inaccurate. For example, if you buy a stock at a certain price and the market drops, you may cling to the original price and resist selling at a loss, even if the asset's outlook has worsened. Why is this important? Anchoring can prevent you from making rational decisions when market conditions change. You may hold onto a significantly devalued asset instead of cutting your losses. How to counter anchoring bias. Reassess your investments regularly. Base decisions on the asset's current value, not just your purchase price. Focus on current data. Evaluate assets using up-to-date information rather than past metrics. Stay flexible. Be willing to adjust positions as new information arises. 5. Overconfidence effect. Believing you can predict the market. Many investors fall into the trap of believing they can accurately predict market movements. This overconfidence bias can lead to excessively risky investments. Why is this important? Overconfidence might lead you to take disproportionate risks, assuming you're in control. This can result in significant losses if the market moves unexpectedly. How to avoid overconfidence. Accept market uncertainty. Predicting the future is impossible, so it's essential to diversify your portfolio to mitigate risks. Stay humble and realistic. Even the most experienced investors can't foresee every market fluctuation. Limit positions in overly speculative assets. Learn from mistakes. If you make a bad decision, analyze it objectively and apply lessons to avoid repeating the same error. Conclusion: psychology plays a critical role in financial markets. Human emotions like fear, greed, overconfidence, and anchoring often lead to irrational investment decisions. By understanding these mechanisms, you can make more thoughtful choices and better safeguard your investments. Don't let your emotions dictate your financial decisions. Thank you for watching this video. If you found these insights helpful for understanding the psychology behind markets, don't forget to subscribe to Next Vault for more content on investing and financial psychology. See you soon on.